Everyone loves to throw around the word compounding like it's some kind of magic trick. But here's the hard truth. If your strategy's broken, compounding won't save you. This isn't fairy dust. It's math, mindset, and mechanics. And in today's video, this is how to actually make compounding work for you. I'm going to show you how real people, without millions or fancy titles, use this principle to quietly build serious wealth. Because yes, compounding can change your life, but only if you stop doing what most people do wrong. Let's flip the script and finally make it work for you. Let me tell you about Camila. She was a school teacher in Texas, not a Wall Street pro, no inheritance, just someone with $100 a month and a big vision. Camila started investing small in SCHD and focused on consistency. But here's where her story shifts. She used a notebook. Every quarter, she logged her dividend, share count, and new income. That tiny ritual kept her motivated. Fast forward 10 years, she had a $98,000 portfolio generating over $3,000 a year in dividends. She never skipped a reinvestment, never chased hype, just tracked progress, kept it boring, and let the system roll. Meanwhile, her brother jumped from crypto to NFTs to tech stocks. A decade later, he had stories. She had income. So ask yourself, are you chasing trends or building something that compounds? If you're serious about creating an income machine from consistency, drop compound in the comments and subscribe to the channel, because now we're getting into what really makes this strategy work. And it starts with what you invest in. Let's dive into the very first topic of how to make compounding work for you. And it all starts with the foundation. And just like any solid recipe, it begins with the right ingredient. Enter SCHD, Schwab's U.S. Dividend Equity ETF. Now, you might be wondering, what makes SCHD so special? Well, think of it this way. You can't bake a world-class cake with bargain bin flour. You need quality, and SCHD is the high-grade ingredient your portfolio deserves. It's not flashy, it's not trendy, but it's focused, and that's exactly why it works. Let's break down what makes this ETF stand out from the crowd. First, it screens for quality. These aren't random high-yield stocks. SCHD includes companies with solid earnings, high returns on equity, and sustainable dividends. Second, it's a dividend grower. The companies in SCHD aren't just paying you. They're often increasing those payouts year after year. That growth helps you outpace inflation and makes your income future-proof. Third, low fees. We're talking an expense ratio of just 0.06%. That's pennies on every $100 you invest. The less you pay in fees, the more stays in your pocket and compounds. Fourth, stability. SCHD is less volatile than most growth-focused ETFs. It's not trying to impress you with big swings. It's trying to pay you steadily. Fifth, it has a proven track record. Since its inception, SCHD has delivered competitive total returns with far less drama than the broader market. And here's what most people miss. SCHD is a tool. It's not the strategy, it's the engine. The magic only happens when you combine SCHD with consistent habits, automation, and patience. You want a machine that builds your future income in the background? Start here. Now that we've picked the right engine, let's see how to actually make it work. Now let's talk about SCHD Edition and see how to actually make it work by activating the loop most people overlook. Let's break it down. You invest in SCHD. It pays you dividends every quarter. You use those dividends to buy more SCHD. Then those new shares pay more dividends, which you reinvest again. What you've just created is a compounding loop. It's slow at first, but once the dividend snowball grows, it starts throwing off monthly income without you lifting a finger. And it gets better. SCHD isn't just paying consistent dividends, It's increasing them. That means your future income doesn't just depend on how many shares you own, but how much each one earns you. Here's the uncommon insight. Most investors obsess over share price, but dividend investors focus on income growth, and over 10-20 years, that's what changes your life. Here's another layer. Dividend reinvestment buys shares even during market dips. That's called dollar cost averaging. You're not timing the market. You're letting your plan buy when prices are low, which boosts long-term returns. And the more you automate this process, the more predictable your income path becomes. SCHD pays you, you reinvest, your share count grows, your income compounds. Rinse and repeat. Think about this. Would you rather have a $500,000 portfolio that swings wildly or a $250,000 one paying $1,200 a month in passive income that keeps growing? That's the mindset shift. As Albert Einstein once said, compound interest is the eighth wonder of the world. He who understands it, earns it. And now that you do, let's talk about the number one way most people destroy this process. Enter the dividend decision, seed or snack. Let's be real. This is where 90% of people mess up. You start investing. SCHD pays you $100. You think, cool, dinner's on me. But every dollar you pull out early is like slamming the brakes on a speeding train. Let's look at two investors. One reinvests every dividend. The other starts withdrawing after 5 years. At year 15, the reinvestor has more shares, more income, and more momentum. Why? Because compounding thrives on consistency. It hates interruptions. Economist Richard Thaler explains this with mental accounting. We treat dividends like bonus money, so we spend it. But in doing that, we break the compounding loop. John Bogle said it best. Reinvesting dividends is the ultimate example of letting your money work for you. You want financial freedom? Then treat dividends like seeds, not snacks. Reinvest first, harvest later. That's how wealth is built. By the way, if you're enjoying the video so far and want more topics like this, comment the word "more" so I know. Let's move on, because the easiest way to stay consistent is to automate it. This is how to actually make compounding work for you by taking willpower out of the equation. Enter DRIP, the Dividend Reinvestment Plan. With DRIP enabled, your brokerage automatically uses every dividend SCHD pays to buy you more shares. No thinking, no clicking, no "I'll do it later." It's just happening, in the background, every single quarter. Platforms like Fidelity, Schwab, Vanguard, they all offer DRIP. It takes 2 minutes to set up, and once it's done, your income starts buying you more income. That's compounding on autopilot. Why is this powerful? Because habits beat hacks. DRIP removes friction. No second guessing. No temptation to spend that $46 check on Uber Eats. It just rolls back into the machine. Yes, you still pay taxes on reinvested dividends. But here's the thing. DRIP magnifies your long-term gains. And if your goal is income freedom, you're playing the long game anyway. Here's a fun fact. A 2022 JP Morgan study showed that investors who automated dividend reinvestment had 27% more income at retirement compared to those who didn't. That's not small potatoes. So if you've ever wondered, how do I stay consistent? The answer is simple. Make it automatic. DRIP turns your passive income into progressive income. It's the treadmill that runs while you sleep. And if you're really serious about building that dividend machine, this is non-negotiable. All right, now let's talk about what all this looks like when you finally flip the switch and start collecting those monthly checks. So, what happens after years of reinvesting and watching that income snowball grow? At some point, you flip the switch. This is the moment where actually making compounding work for you stops being theory. and starts becoming your real-life paycheck strategy. Let's say you've spent 15-20 years reinvesting every dividend. Your share count is massive. SCHD's dividend payouts have grown. Your compounding flywheel is now running at full speed. Now you disable DRIP. Instead of using those dividends to buy more shares, you let them land in your cash account. Congratulations! Your portfolio is now cutting you a paycheck every quarter. Automatically. And we're not talking peanuts. A solid six-figure portfolio in SCHD could be sending you $6,000 to $12,000 a year in passive income. That's mortgage help, grocery money, travel fund. You didn't chase crypto pumps or 5x meme stocks. You built it the boring way, and boring works. But here's where it gets tactical. To make this income last through retirement, pair your SCHD income with tax-efficient withdrawal strategies. Consider drawing from taxable accounts first, letting Roth or 401k assets grow untouched. And don't forget about Social Security timing. It matters more than you think. You can also mix strategies. Withdraw a portion of dividends while still reinvesting some. That way, your income stream keeps growing even after you retire. Remember, the goal isn't just to collect. It's to preserve and grow income without selling off your assets. This is the real definition of financial independence, not watching your net worth on a screen, but getting paid while doing whatever you want. Up next, let's talk about the mistakes that quietly kill this strategy and how to avoid them like a pro. Compounding work for you by not making the same mistakes most investors make. Because here's the truth. Compounding is fragile. It works brilliantly until you interrupt it. Mistake 1. Selling during downturns. SCHD drops a few points and panic sets in. But long-term investors, they see dips as discount seasons. The wealthy don't flinch, they buy more. Why? Because they know that staying in the game matters more than timing the perfect moment. Mistake 2. Obsessing over share price instead of income growth. You might feel clever watching SCHD go up $2, but if you're ignoring rising dividends and long-term payout potential, you're missing the real compounding engine. Mistake 3. Chasing high-yield alternatives. When people abandon SCHD for some random 10% yielder without stability or history, that's not compounding. It's gambling in disguise. Slow and steady may be boring, but it builds empires. Mistake 4. Stopping contributions. Whether it's $50 a month or $500, the key is momentum. Interrupt the flow, and your snowball melts. Remember this. You don't plant a tree, dig it up every year, and expect shade. You water it. You wait. Then one day, you're sitting under it. This is how you turn SCHD into a long-term retirement machine. Not by reacting, but by committing. So ask yourself, are you building momentum or breaking it? Next, we'll walk step by step through building your very own SCHD-powered income roadmap. Something you can follow whether you're 25 or 55. By now, you know how to actually make compounding work for you, but let's go from theory to blueprint. Here's your step-by-step plan to build your own SCHD compounding machine, even if you're starting small. Step 1. Open a brokerage with DRIP options. Choose a brokerage that supports dividend reinvestment. Fidelity, Schwab, and Vanguard all make it easy. Make sure it's an account you're comfortable navigating, because this will become your financial command center. Step 2. Make that first investment. Don't overthink this. Whether it's $100 or $1,000, just buy SCHD. Your first dollar is more important than your 100th. That first share, it's the seed of your financial oak tree. Step 3. Turn on DRIP. Don't skip this. Go into your account settings and enable dividend reinvestment. From now on, every dividend gets recycled into more shares. It's like installing a financial recycling machine that turns income into more income. Step 4. Set up monthly contributions. Consistency beats intensity. Even $50 a month adds up. Set it and forget it. Let automation do the heavy lifting while you focus on earning more or sleeping more. Your choice. Step 5. Track share count, not just price. Your goal isn't timing the market. It's building ownership. Watch your share count grow. Watch your income snowball. That's the scoreboard that matters. Step 6. Stick to the plan. There will be headlines, crashes, FOMO. Ignore it. You're not chasing hype. You're building a machine. As Jim Rohn once said, discipline is the bridge between goals and accomplishment. This strategy is simple, not easy, but it works. Coming up next, let's look at how much this could actually pay you if you stay consistent for 10, 20, or even 30 years. Let's zoom out and ask the big question. If I stick to this compounding strategy, what could it actually pay me? This is where theory becomes tangible, and this is how to actually make compounding work for you. Let's say you start with $10,000 invested in SCHD and you add just $200 a month. With an average annual return of 9%, which includes dividend growth and share price appreciation, that portfolio could grow to around $105,000 in 20 years. Not bad for something on autopilot. But here's where it gets real. Let's assume SCHD continues paying and growing its dividend at a rate of around 6% annually. At year 20, your portfolio might throw off $4,500 plus a year in dividends, completely passively. And that's if you pause DRIP and start withdrawing. If you kept reinvesting, that number gets even crazier. Now picture 30 years. That same strategy could grow into $270,000 plus with over $10,000 in annual dividend income. That's monthly checks for the rest of your life, without ever having to sell a single share. Your portfolio becomes a paycheck machine. And here's what's wild. These aren't retirement plan numbers. This is what happens when you commit to a simple, repeatable strategy, starting with whatever you have now. Most people overestimate what they can do in a year, but massively underestimate what's possible in 10, 20, or 30 years with consistency. It's not about overnight success, it's about compound momentum. Coming up next, we bring it all home, and I'll show you how to align your habits with this machine, so you don't just build income, you build legacy. And there you have it. Now you know. This is how to actually make compounding work for you. Not with hype, not with timing the market, but with a simple set of habits repeated consistently over time. You saw how SCHD gives you quality, growing income. You saw how reinvestment transforms small checks into serious cash flow. And you saw how automation, via DRIP, takes the guesswork out of the game. This is how wealth is built, quietly, predictably, and without apology. So here's the question. What step will you take today? Set up DRIP, track your dividend growth, add $50 to your portfolio? Remember, you don't need to be a genius. You don't need to be rich. You just need to be consistent. Remember, this video is for educational purposes only and does not constitute investment advice. It is important to conduct thorough research and consult with financial professionals before making any investment decisions. The value of investments can fluctuate, and past performance is not indicative of future results. Always assess your risk tolerance and investment goals before allocating your capital. If this message resonates with you, I recommend you watch this video next. Thank you for joining us today. We hope you found this video informative and exciting. If you enjoyed it, give it a thumbs up, share it with your friends, and don't forget to subscribe to our channel. See you in the next one.